Hello and welcome to today's virtual coffee talk webinar. My name is Margaret and I will be your web host for today. We have a couple of housekeeping announcements and then we will introduce our speakers. In order to earn CPE credit for today's session, please stay connected to the webcast for the entire program and participate by responding to at least 3 out of the 4 poll questions. Secondly, there will be a course evaluation which will open in a new window upon exiting the webcast at the end of the program. With that, I'll introduce our speakers. Kevin M. Jacobs is a managing director with Alvarez and Marsal Tax in Washington, D.C. and the National Tax Office practice leader. He brings more than 15 years of experience in tax matters in both the public and private sector. Kathleen King is also a managing director and national R&D practice leader with Alvarez and Marsal. With more than 25 years of experience, Ms. King specializes in assisting clients in the process of claiming domestic production deductions, documenting, and sustaining tax incentives. Finally, Kevin DeYoung is a lead product manager with Wolters Kluwer Tax and Accounting. After the presentation, he will be showing us how to find additional answers and resources using CPH Answer Connect. Kevin, take it away.
Great, thanks, I appreciate it. So today we're going to talk about Section 174, which may be deja vu for a lot of you, as we just recently had a virtual coffee talk on this, but what is old is new again, as the IRS decided to drop a fun and exciting notice on us, which is given some guidance, and it's highlighted by the topics that we're going to talk about. Some is helpful, some is head scratching, and some is why did they decide to do this, and can we put that part to the shredder. But with that said, the agenda for today is, we're going to talk about what is the 174 guidance, how did we get here, then identifying and calculating what's called SRE expenditures, and then delve into the hot topic of what is software development activities and what has to be encompassed in that and what is the implications. Then talking about research performed under contract. This is something that's been a hot topic associated with even related as well as unrelated parties. And then clarifying the next provisions and next steps. And as always, Kevin DeYoung is going to then wrap up and show us additional information that we could find on Answer Connect. Before we delve into 174, I just want to do one quick plug for next month's virtual coffee talk. We're planning to talk on the employee retention credits, which is another hot area. That's scheduled for Halloween, in which Kevin DeYoung said he's planning to dress up, so everyone should log in to see what that is. So with that, let's sort of jump into the 174 guidance. And 174 was part of the fun and exciting TCJA, where they said, okay, we need some revenue. And so as a result of that, we're going to require the capitalization and amortization of research and experimentation costs. Now, at the time when they actually enacted this, it was a revenue raiser, but no one anticipated it to actually come into play. Well, as we've seen from the congressional dysfunction, no one has been able to delay the implementation. And so as a result, 174 is now live. And taxpayers are faced to really struggle with, how do we determine what is and isn't subject to 174? And what should we be doing from both a preparation for a tax return position, as well as financial statements, as well as potential audits? So I guess, Kathleen, from there, where are we? What should we know? And what's the next steps?
Thanks, Kevin. So as Kevin mentioned earlier, we have finally gotten our first guidance in terms of how to interpret these new rule changes that are effective at the beginning of 2022 for taxpayers that have calendar year returns. And many companies obviously couldn't wait until September 8th before the due date of returns to get started on this. So there's already been a lot of work that's gone in to try and figure out what are we dealing with here, and how do we respond. So there was a notice that was published in early September 8th of this year, that again dug into some areas. They asked for a lot of feedback from taxpayers in terms of they're asking for they're not sure where to go with it. These are obviously complex matters. I think that what's very clear, at least from Treasury's point of view, is again, this is not a simple change to implement for taxpayers because it has a lot of tentacles in terms of how 174 interplays with other provisions. But so we've got our first sneak peek in terms of what they're thinking, and I'd say, as Kevin said, kind of a mixed bag. Certainly helpful to get a little bit more clarity on some of these points, but there's still a lot of question marks that are out there. They introduced a number of new terms that, again, some of which they seem to have some interplay with the research credit. Other are just brand new in the context of the 174 guidance. We're going to talk about some of those terms in a little bit more detail, but I guess in terms of my overall reaction to the guidance, I mean, first of all, very welcome to have any type of view in terms of, what are they thinking in terms of what's in, what's out. I was very pleasantly surprised in terms of where they went with in particular, what is a cost incident to research. I think that whole discussion in terms of the types of expenditures that should be included, it was reasoned. It didn't go. We were worried about a full 263 cap A, unicap, let's a little bit of everything included. They didn't go quite that far. That was very promising. But it does raise some questions. And I guess in my mind, as someone that's worked on research credit issues for more than 2 decades now, it raises some questions because they're now starting to use terms that were only ever used in the context of 41 before. And all of that is overlaid when you look at the preamble language to the notice. It talks about they really weren't intending to make changes to 41, but I think the reality is now that we're starting to mix some terms and topics a little bit more, it is going to create some question marks. So if we dig into, I guess, the next section, Kevin, if you can maybe address some on the timing and you're muted.
Technology at its greatest, it self-muted me. So it's important to note that the IRS and Treasury are using the notice feature more and more often, right? We've seen this in 174, we've seen this recently in CAMT. And so it's great to see this preview, but it's also important to appreciate this is just a notice, right? And so the notice does provide that taxpayers are able to rely on it before the publication of regulations. It's an interesting, for those that are fascinated with administrative procedures, it's not, any comments they received is technically not a response to proposed regulations. So to what extent they need to respond to them in preambles, and to the extent they will respond to them in preambles is going to be really interesting. But hopefully what this shows is there is an interest in the government to actually solicit feedback in the forthcoming regulatory process, which is, okay, this is what we're thinking, what should we do? And we, as Kathleen said, we'll highlight some of the issues that they've asked for comments on, which is rather large. Now, with that said, you are able to rely, but again, you're able to rely only if you adopt all of them. So if it is a mixed bag, you have to say, is it worth doing this, or what position can I take until I actually get regulation? The notice does reference expected changes to both 460 and 482. And it's important to note that the deadline is November 24th, 2023. Now, that sort of short window suggests that they're actively working on regulations and hoping to release regulation on the sooner side. With that said, we're all cognizant of the potential government shutdown that is looming and whether or not that puts a halt to any of the guidance that we're eagerly anticipating. So how that all plays out is yet to be seen. With that said, Kathleen, I know you mentioned that there were new terms. Why don't we sort of talk about what those are?
Sure, and some of these we're going to cover in a little bit more detail on some later slides. The ones at the top here, I think, are ones that are maybe the most pertinent in terms of the concept of the specified research expenditures as with respect to what a product is, what with respect to what expenditures are, what with respect to what activities are, and why they've adopted this new concept in part is because when you think about 174, you have to think about it in kind of two buckets. One is the typical R&D type activity where you have uncertainty with respect to the development of a product or process. And so that's the classic 174 type of cost that we would be looking at. But what's new here is they've specifically added on in this, and this is a statutory change, that software development is also considered a research and experimentation expenditure. And it's very interesting because, again, in all contexts, it's in this notice, it talks about you have R&D 174-2 costs, you have software costs. It's always kind of bifurcated. So there's definitely an implication that there's a difference between what they're expecting under software versus what they're expecting under the classic 174. And then again, this term, this SRE term, is really all around what is an activity that incorporates both of those prongs. They've largely adopted the definition of foreign research that's existed in other contexts, including Section 41. People at the Treasury have gone on record as saying that they did look at the 174 guidance that's out there, whether in terms of case law, because they actually reference some cases in here that they looked at, in terms of some of the regulatory guidance that's out there. So definitely a reference back to 41 to try and leverage some of the learnings there. What I've heard from a couple sources is that there's actually maybe sitting in a drawer somewhere, at least a set of regulations that have been drafted, not intended to be final regulations. I think that even on the government side, there were a lot of question marks and debate in terms of some of the provisions. And so as Kevin was alluding to earlier, I think it's just a much easier and quicker process for them to get the notice out as opposed to proposed regulations. And so that's why they went that direction. I would say that, again, what I've heard is that they were trying to be helpful in giving this guidance so that companies that had not filed yet, that they would have, a little bit more certainty in terms of, where they were going with this particular guidance. And on some of the key issues that are out there, again, there's certainly some understanding on the part of Treasury of some of the concerns that are raised here. I guess a couple things that we're going to get to later on that I think are important is this whole concept, and it's specifically in the context of software, of what an upgrade and enhancement is. That's a new term that's defined in these regulations. And again, I think there's the way it's worded has some interesting implications. They do spend a lot of time in terms of talking about contract research arrangements. I know that's an area, depending upon the industry that you work in, there are a lot of question marks that are there. They raise or define financial risk, again, in the context of 174. It's interesting for me looking at how they're looking at risk and rates, how that kind of, when you compare that to the guidance that's been out there for many, many years on the research credit, you see things that are similar. You see things that kind of make you scratch your head in terms of, are they trying to change the rules here? They said they're not, but it's raising some questions. And then I think really that bottom bullet point on this particular slide, a new concept that's included in here about looking for items, and this is from a rights perspective, items that are subject to protection under applicable foreign law or domestic law. That concept is new in this particular area, and we'll talk about that a little bit later in the presentation.
Great. And so, it is really interesting. We've seen in other regulatory packages, just to sort of note, where Treasury and the IRS have said, no inference should be drawn from the following. And that's clearly what they're trying to stake out here. which is, whatever they do in 174 should be limited in 174. But as Kathleen noted, it's sort of this interesting provision to what extent that actually applies, right? And can taxpayers make inferences? Now, it's clear if the government is saying that there should be no inference, they presumably wouldn't be drawing inferences, but it doesn't necessarily go both ways. With that said, we're going to launch the first polling question. And just remember, you have to answer the polling questions in order to get your CPE certificate, which is, do you need to make significant changes to your work papers with the new 174 guidance? Yes, my prior interpretations do not match the latest guidance. No, my current method is generally within scope. Or no, I'm not sure because I haven't had time to analyze it. So Kathleen, while they're filling out the survey, why don't we start talking about the identification and calculation of 174 expenses?
Sure. So the next slide that it is something that if you attended our last the webinar on 174, you would have seen a very similar type of slide. And again, so that was before the guidance was issued, but it's where we had tried to draw what we call an expense continuum. And what it's showing is when you have costs, again, the concept is incident to R&D, there are certain costs and activities that really are probably closer to a true R&D cost for financial statement or other purposes, however you define R&D. I think most would agree that, for example, if you have the salaries of scientists working in an R&D area, that's obviously in high likelihood. We know those types of costs are included in the continuum and it should be capitalized under this provision. And if you go down the continuum to the lower likelihood, again, by and large, the guidance that was issued, it validates the way we've kind of broken down the continuum in terms of the types of expenses that would be expected to be included. The one thing I wanted to highlight, though, is what it actually says in the notice is that it's a non-exhaustive list. So they go into a fair amount of detail in terms of types of costs that should be included, types of costs that they don't expect to be included, but they do caveat by saying this isn't everything. They're not trying, and they can't because there's just too many variabilities from business to business to try and cover everything. And so that's why I think it's still helpful to think about this continuum, because depending upon where the expenses fall, they're less likely to get included. And again, things that it's very clear if it's just operating a website, if it's just doing production in a manufacturing facility, those are things not intended to be covered here. I think part of the challenge is there are activities and costs that kind of blend in to just about every area of the business, but by and large, not in scope. Same thing with sales and marketing, G&A. Again, I think this was an area of very favorable guidance where it did specifically call out and highlight some areas that they, again, deemed to be areas of indirect support to research, because again, HR is one that was flagged. And that's an area that, again, everyone needs a paycheck, but they acknowledge that really they weren't intending to pull in every type of cost within a business organization. So going to the next slide, this is where we start to get to the buckets that they addressed in the notice. And again, the way we have it highlighted here, this is in the context of labor costs, and what they did was they identified, again, types of costs that they thought fell under this definition of labor. And why that's important is if you look at a lot of the pre-existing regulations under 174 and the examples that were in those regulations, many times they would talk about salaries or they would talk about labor costs generally. They didn't, they really didn't pull in some of these additional costs, but there was some basic references to labor previously. And so what they've now done is they've built out some specific types of expenses in the labor environment that they think should be included. So I know that payroll taxes is an area that, again, as we were analyzing what should be included or not included, thinking at that whole continuum. That was one that we had a lot of debate internally. Is it supposed to be included or not? This guidance says it should be. Obviously, base salary, any type of overtime. I think vacation and holiday was another one that at least got some discussion as we were debating prior to this guidance whether it should be included, because obviously that's non-working time. And the question is, does it make sense that non-working time would be associated with R&D? Well, again, the guidance that's come out, at least for 174 purposes, is those costs are in scope and need to be capitalized. So there's other, there's complexities with some of these things. Some of the pension costs that are out there, the pensions themselves, depending upon how they're awarded and how when they actually hit for tax purposes, you need to make sure that for all these costs, you're not just looking up the financial statement amounts, you're looking at it for any type of M adjustments that might be required to account for these for tax purposes. So, and again, it does include not just full-time employees. That specifically says it's just not just employees, it's contractors as well. So to the extent that you have contractors that are working on activities that are deemed to be these specified research expenditure activities, then these types of costs must be capitalized for purposes of 174. So the next area that they addressed in the guidance and spent a little bit of time on was again, non-labor costs. And that includes things like supply costs, so more consumable type of items. It talks about materials. And again, when you look at the old regulations that we're talking about, whether it was pilot models or other types of activities out there for 174 purposes, historically, this concept of direct materials was in there. I did think it was interesting that they did use language that was really similar to what you find in 41. I don't think it was in the context, used in the context of 174, but it was the difference between used or consumed in research is the guidance that's provided here. And that's always been, as we've looked at things for the credit, that's been a big area of debate that we've had to go through with the IRS, because in their mind, they were reading the statute to say that in order to claim it for the research credit, these are costs, the material costs for things that had to be used up or consumed. And they've now adopted similar language in 174 to make it clear that, again, it doesn't necessarily have to be used up. That's consistent with the guidance they had historically released or previously released on pilot models and allowing those for qualification, even if they were sold. And then tools and equipment. And again, the tools and equipment that are referenced here are ones that, again, they're generally expensed. So to the extent that you have costs that are capitalized for tax purposes and you are depreciating those costs, you have to pull in the cost of the depreciation of those items into the 174 calculation. And then finally, the other area where they provided guidance on, again, these are what types of costs are incident to research, is they looked at 174 expenses that fell under what they described as management or operation type costs. And Kevin, can you go to the next slide? And so again, another area here, this is not intended to be all inclusive in terms of the types of things that should be accounted for 174 costs, but it did start to paint a broader picture in terms of what companies should be looking at and how things could potentially get pulled into this assignment, or to this calculation methodology. A couple things I would call out here, and again, these are all areas specifically listed in the guidance as being areas that they would expect a portion of these costs, to the extent they relate to research activities, that these are types of costs that they would expect to be included. this is insurance, and this is property insurance. This is, the health benefits and employee benefits. That's really more on the labor cost that we were talking about earlier. But, facility type insurance costs are things that they would expect to be accounted for, again, to the extent it relates to R&D. Rent or other types of facility costs are definitely in scope here. I thought it was interesting, the two I would just kind of flag here, is it just sort of made me like say, and scratch my head a little bit, is one for travel costs. And again, what they're saying here is, to the extent that you have employees that are traveling for research purposes, they are expecting those costs of travel to be included in 174. What was interesting about that is that they, in talking about travel costs, they say this is travel costs not just of those individuals that are performing research services, but they specifically mention it also includes travel costs of direct support type personnel. And so they have broadened it to say, again, if you have individuals that are in any way really connected to this research activity, they specifically mention it for travel costs, but it could be applicable for any type of expense out there. The other one that I think that companies need to think about in terms of how they're including it is the security one. I guess that item surprised me a little bit because there's very few businesses that you go to today, whether it's in some of the larger cities. I work in Washington, D.C., and just about every business here has some form of security desk downstairs, and it really doesn't matter what is going on within that building. There's just general security, and to me, a lot of those security type costs are not related to research. I mean, to the extent that you have a secure facility, you have restrictions where, again, you just have to protect that security. I think that's different than just general building security. And the way the guidance is written across all these expenses is they still, at the end of the day, have to be related to research activities. And so, again, if you can show that you have security costs, and it's for a building that does nothing but HR and marketing and non-qualifying type activities, then even though security is called out as a potential expense, you wouldn't include that. And I would say that would similarly be for security activities. The difference is, it doesn't necessarily mean that you have to apply a flat percentage to that security cost, like meaning that if 50% of your folks are spending time on research, again, look at the security cost itself. Look at any of these costs themselves. If you can show that, for example, you have a building that does both manufacturing and utilities, it's very likely, manufacturing and engineering, it's very likely that the utilities are heavily weighted toward the manufacturing side of things. And so you don't want to do it based on headcount necessarily. You don't want to do it based on square footage. You need to consider, and that kind of ties into the next area that they touched on with respect to these activities, and that is they did give broad flexibility in terms of how to allocate these costs. And when you look at the slide that talks about those, can you go to the next slide for just a second, Kevin? And then we'll come back to this one. So when they talk about what costs should be included that are research in nature, as we are going through that list, again, they specifically said that they were trying to afford flexibility here because, again, they're acknowledging the differences from industries in terms of how costs should break out. But one thing that they did say is they are looking for consistency. If you choose a particular methodology, so you're going to allocate your rent based on a headcount basis, then you can't be flipping back and forth between, okay, I'm going to do headcount one year and I'm going to do square footage the next year because we added a new building. They are looking for consistency, and they even raised the point that at the end of the day, what they may end up requiring is, if you do change your method, that would be an accounting method change that would require a 3115. And again, that's obviously looking ahead to future years where you may want to make those changes. So if you go back to the prior slide for just a second, Kevin,
Yeah,
again,
and
the other thing that they did call out is some specific costs that they said are not research and experimentation costs. And this is also very helpful, again, when we were looking at that continuum in terms of, you know, what activities should be in play here. G&A is, you know, the one that stands out the most. That was very helpful for taxpayers to get some assurance that some of those, again, indirect type departments are not in play. And again, same thing with training costs. They specifically call out training with respect to software solutions. And if you are, you know, rolling out a software solution and you're training individuals, but I think the general training concept as not being an R&D type expense, it can be broadly applied across other areas of the organization as well. There's an old, I think it was an FSA from the early 90s that talked about training as being kind of a management type cost and therefore out of scope for what we're looking for here. It also specifically calls out, you know, a number of items that we can't go into detail on today with respect to operating websites and software systems. You know, specifically website hosting was a cost as an example that was called out. They also called out, you know, interest on debt related to actually buying research facilities or financing the construction of research facilities as being something that were outside the scope of what was in play for capitalization requirements. So helpful. I think that the language they use for the things that are not treated as SRE is a little bit different than what they do for those costs that they specifically said are SRE. And what I mean by that is that in the context of what doesn't fall under this bucket, they were saying this is a list. They don't say, no, there might be others. They're just saying it was much more narrow in terms of how they presented the costs excluded, where it was much more open in terms of these costs are specifically in scope for 174, there might be more. So keep that in mind. So if we
let's
get
one
ahead of
the next following question of when do you expect the proposed regulations to be issued? Before the year end, early Q1 or mid 2024. It'll be interesting to see the thoughts on that. You know, we did get a few questions and just to sort of address them, which is there's not a size limitation, unlike other TCJA provisions. For example, like 163J has an out based off of gross receipts. And the other thing just to note is, as Kathleen noted, there is flexibility as to approach, and that flexibility is beyond just industry, right? In the sense of you do need to be consistent on how you're allocating expenses, but you need to then think about, in certain instances, can I segregate, like utilities might be different than how I allocate my rent. And so as long as you're sort of thinking of my expenses in the buckets and can I justify them, it's going to be really important. And that goes to what we've talked about before, like the documentation associated with that. And so being mindful of that, you know, stock comp is a great example of like, what are the metrics that give you stock comp? It might be that, you know, my time is split 50-50, but my stock comp is really associated with this division and the performance of that division. Well, does that then drive, and can I even segregate my costs? So there's a lot out there, and really the devil's in the details, and really it's important to really document to make sure that you are being able to establish if the IRS comes in and says, how are you doing this? And have you consistently done it? You said, yeah, here's my methodology and this is my approach. And by the way, I've always been doing it this way. So I guess, Kathleen, why don't we switch to software development activities?
Sure. And you know, a couple of things on we asked the question, when do you expect proposed regulations? Again, from our perspective, I've heard some, at least one or two Treasury officials, I think I've heard it in two contexts now, where they pretty much said don't expect it before year end. So we are looking into, you know, probably spring of 2024 was when we would expect the guidance to be issued. Part of that is there's probably going to be some turnover in the government, depending on what's happening with the, if the shutdown happens, that might delay things further as well. So even though, again, my understanding is they do have a good draft of where the direction they're going. They obviously are giving folks until end of November to offer some thoughts. We assume that they are going to account for those in the guidance as well. So we are probably looking at the earliest spring in terms of when this is going to come into play. So again, I mentioned this earlier, but keep in mind that with respect to this guidance, there really are two distinct buckets of activities that they just in the guidance they say there's software and there's other R&E, and so they are expecting it to be different in terms of some of the rules and how they're applied. And again, this is another area where, especially on the software side, the IRS has never been a huge fan of internal use software for purposes of the credit. And so it just makes me, a little bit more leery when I see some of the nuances that they're putting into this particular guidance. And again, they have similarly adopted language that they have in the pilot model regulations, where they do say it can be in the context of not just a product, but also a component or a subcomponent in terms of how you would go about identifying R&D activities and R&D costs. So it is intended to be a more granular level of information. I think one of the things, again, in my mind that I'm wondering about is right now they haven't talked about requiring any of these 174 costs to be presented in any type of project level, or, and again, in the context of the research credit, they talk about business components. That's a huge focus right now in IRS exams based on some recent court cases that have come through. It's just, again, it'll be interesting to see if they try and move in the context of 174 to some of those more project by project assessments as well. So again, software development, kind of the ugly stepchild of R&D, as I like to think about it. When you look at the next slide, it's, they did answer a couple of questions that people were asking for guidance on with this new inclusion of computer software in the context of 174. And one of the things that they help define is what do they mean by software development? Not just what is computer software, because that's been out there for prior years in terms of the types of activities that are included. Kevin, can you go to the prior slide for just 1 second? I do want to make sure I cover upgrades and enhancements, because this is a new term that's being incorporated in the software section. And generally what it's saying is that, what is an upgrade and an enhancement? That's intended to be, you have existing software and you are making modifications to that software. And the standard that they're looking for software that's used by a business, so again, this is in the R&D credit context, more akin to internal use type software. What they're saying is after the software has been placed in service, they're expecting for it to, in order for it to be an upgrade or an enhancement, there has to be one of two things. There either has to be, enabling functionality or new capabilities that are added to the software because of that change, or there has to be a material increase in processing speed. And so I just flagged that again, that whole concept of when they're talking about upgrades and enhancements for software used in a business, they have put a little bit of nuance in terms of once it's capitalized or placed into service, what does that mean for future expenses? And I think that again, it just raises some question, because these days a lot of software, it's not like there's one release a year or two releases a year. Because of the agile software development methodology process, there are a lot of software changes that are rolled out on a monthly basis, or even more quickly than that. And so when you are continuing to place things in into service, I think it may raise a few questions in terms of, are you going to meet for internal use software some of those material increase standards that are included in the guidance currently? So again, the next slide, though, very helpful in terms of they have started to define what is software development. Because again, that was the big question mark, because when you looked at Rev Proc 2050, when you looked at 197 and their discussion of intangibles there, they've always defined what was meant by computer software, but they didn't really define what is meant by software development. And those are the types of activities that we have to account for 174 purposes. And so what they did was they included a software development life cycle, so to speak, in the guidance. And they talk about how, starting from the planning stages of software development, so the gathering of requirements, that those early stage type things, that's the beginning of software development. And they take it through the testing phase. So it includes the design, it includes the build, it includes writing code, it includes testing. And they say it includes modifications to address defects. And that's somewhat important because, again, when you're looking at, they do have different cutoffs for software used for internal purposes versus software used, for sale. And again, I think there are some question marks that are out there in terms of, what if you are an online business? And so, again, for research credit purposes, there's been a lot of great guidance that has helped companies say, okay, I have an external focus. It's being used not for us internally to run our operations, and therefore it's not internal use for purposes of the research credit. I think there's going to need to be some similar discussion here. And the only thing else I would highlight in terms of what they haven't included as software development, or this is actually what they have included, is I'm a little surprised on that first bullet point where they're talking about the planning activities. Because even though they're saying that's in scope for 174, I would tell you for financial statement purposes, a lot of that early stage type of gathering requirements and assessment, that's not capitalized for book purposes. So that's it. This is a broader range of costs that are included for tax purposes. And I would also highlight that it's an area that, again, when the IRS audits these claims for research credit purposes, they oftentimes try and disallow some of those early stage work for the credit, even though it's clearly intended to be in scope for 174. So again, specific listing of some areas. Again, this is generally helpful in terms of what's not included in software development activities. We talked about the training, the business reengineering. Again, if it's more in the nature of data, like you're creating data, installing data, you're really not doing any kind of programming or coding per se, that's not included in scope here. So I think it was helpful to have some of these call outs that, again, but they did differentiate for maintenance activities. If it's not an upgrade or enhancement, and keep in mind there is a specific definition of upgrade and enhancement, then contemplates more than just a simple change. Like they're looking for activities that otherwise, either add new features or again, that substantial improvement in performance of the system is required. So the last section that we were trying to touch on today is the research performed under contract, and we could literally spend a whole hour dissecting this particular section. There's a number of nuances here. I think different taxpayers in different industries, even within the same industry, they feel like there's different ways to read this. But they did, as they were coming up with this language, they did generally develop a rights and risk approach to assessing the implications for research services or the development of a product, a SRE product as they've defined it, and how those risk and rights should determine how they're treated for capitalization purposes. And so again, you have to look at all three of these factors. I think the contractual activity itself is one that's overlooked to some degree, I mean, again, if you look at the contract and it's very clear, that it's intended to be a non-research activity. You are buying a product that there's performance guarantees that come with it. That look at the contract to help you understand in terms of where it falls on the continuum. And so, in the spirit of new terms that are introduced, one of the key ones is, again, they raise this concept of financial risk. And so what is financial risk for purposes of 174? And again, this is not the same language that's used for credit purposes. So when you're looking at funding, and they never use that word funding in the context of 174, there are different nuances, whether it's as you're looking at the rights provisions, where it's very clear under, for research credit, clear as mud, for research credit purposes, that again, if you have, you could have shared rights and still retain substantial rights. Again, the concept of substantial rights and shared rights not addressed at all in this particular guidance. But when they talk about financial risk, they're talking about the risk of financial loss related to the failure of the research. And I think that area that's bolded on here is important to consider, because it's not enough that you could suffer a financial loss, because you could have a fixed price contract and you just overrun and you're in a poor economic experience. The contract has to contemplate that the reason for that loss is related to potential failure of research. And then the other thing to call out on this particular slide is that bullet that's talking about, and again, this is a new term in terms of, what do they mean by subject to protection under applicable domestic or foreign law? And what I think is interesting, again, it just begs the question, what do they mean by that? Are they talking about patents? Are they talking about trademarks? Are they talking about copyrights? Again, it's possible the trade secrets could fall under this particular definition. They don't define it, but trade secrets are definitely something that could fall under this. It could also include potentially filings for pharmaceutical companies where they file with the government to get things approved. Again, from a trade secret perspective and other perspective, one of the important things that you have to be able to show is that there's some economic value from another party not knowing that information. And again, those are protected by law. Excuse me. So I guess with that, Kevin, why don't you jump to your slides? And the last polling question.
Sure. So we're going to launch the next polling question, which is, what has been the most welcome guidance provided by the notice, either the cost of costs included and excluded, the software development, research performed under the contract, or none, too little, too late, or none because we haven't had a chance to fully digest the notice. I will just, before we jump to the next area, which is important, just note, right? I mean, these costs that are being paid is really an issue that, as Kathleen highlighted, really looking at what the contract provides. It's beyond that. Like, the contracts are hopefully going to clearly state what are the risks associated with it, what are the rights that you have, what are you actually paying for, who's bearing these financial risks. So it really is something that people need to examine, and unfortunately it's not just this one size fits all, unless all of your research contracts are all like the standard cookie cutter without any changes. And so as a result, again, documentation of how did you make these determinations, what was the implications associated with that is going to be what's key. There were a handful of questions that were addressed by the notice. There were some examples that were provided to discuss the treatment of property subject to the disposition, retirement, or abandonment. And this is the property for which the costs relate. Now, it is helpful. There is some head scratchers, and there's still some areas that they still haven't addressed. So, for example, there's a lot of deemed transactions that are not answered. So how does it apply in a, for example, 338H10 transaction, where you have this deemed sale of assets followed by a liquidation? Does that mean the buyer is now getting goodwill? And so that may create a different answer, while the seller or the seller shareholders get to continue to amortize these expenses. What happens in a 3-2 context is a great question also. So there's a handful of different things that need to be further fleshed out in guidance. The midpoint calculation was defined to use months to calculate the 5-year and the 15-year amortization. And you could see that on this slide, there's this 482 to cost sharing agreements, just to highlight, like, it's designed to be taxpayer favorable, and I fully agree that this guidance is really helpful, but it doesn't answer the question of what happens if you're not subject to the 482 cost sharing arrangements. And there's a lot of related party transactions that don't necessarily fall within this provision. And then there's also a lot of unrelated that don't fall under this provision. So just being mindful of, they've given guidance, but they haven't given all of the guidance that we definitely need. And to that end, they have provided a whole host of areas for where they've requested comments. I know, Kathleen, we have about a minute left. If you want to sort of walk through the potential 174 challenges that we have, and then Kevin DeYoung is going to walk us through answer connect.
So yeah, just really quickly, that I would highlight 3 points that are on this slide. One is, again, as we've mentioned before, what is the interplay or impact going to be for 174 purposes? That's one question that's out there. There's also a question in terms of if you are audited by the IRS in a later year and they come back and say, this isn't 174 or this is 174 and it should be accounted for, how is that going to impact costs already capitalized or costs that have not been capitalized yet? I think there's some questions in terms of how that's going to be accounted for. And then finally, I mentioned earlier, I think there's a big question mark in my mind. What's from a substantiation purpose, what's required in your work papers to be fully responsive to this? And hopefully more guidance is coming sooner rather than later.
That's great. Well, we appreciate it. I guess, Kevin, if you're able to show us Answer Connect. Kathleen, thank you so much for joining us again and providing us informative insights on Section 174. I'm sure we're going to regroup again once we have more guidance on this, and hopefully it will be less head scratching and more yay. So with that, Kevin, what should we know?
Excellent. Thank you, guys. There's great information on all the changes. As we've heard, there's a lot of moving parts. There's a lot of new guidance coming out. Just a lot of areas of uncertainty as it relates to this. Want to spend a little bit of time talking about CCH Answer Connect. We'll specifically look at the research and experimental costs here, but wanted to just take a second or two to take a step back and give you a little bit of insight as to why we created CCH Answer Connect the way we did. As we've heard, there's a lot of information coming from a lot of different locations. Guidance, asking for more guidance, the regulations, the notices, pieces coming through the news. What we saw as we talked to researchers is that their ability to pull this information together was one of the biggest obstacles that they encountered when using a tax research platform. So as we created CCH Answer Connect, our goal was to allow you as the researcher to start at a location and have all the relative information aggregated and brought to you, so you're not jumping from one search result to another search result for document to document to document in hopes that you're actually seeing all relative content. So that's really what we did when we created CCH Answer Connect. And we're going to take a couple of minutes here to run a couple of searches within CCH Answer Connect to show you how we've actually done that. For today's example, since we've been spending quite a bit of time, obviously, with our research and development, I'm just going to start out my search with research. And one of the things that we've done through intuitive search language is begin to drive you as a researcher to content that we believe is relative and on point to what you're looking for. We begin with a host of questions and answers. This is some of the high-level information that we may be able to give you to address or begin to address the question you have. Obviously, with the research and experimental costs, this is becoming very, very complex. It's just going to, again, give you that overview. We're then trying to drive you to or suggest topics that might be on point for what you're looking for. And the definition of a topic for you here is where we take the overall issue and pull multiple sources together and give you the holistic view of the entire issue. give you that understanding, that baseline. We talked about some of the SREs that were out there. We're going to cover some of those in these searches as well. And then we also have our suggested searches below. So for today's example, we are going to go in directly to the research and experimental expenses topic page and want to focus on what we've done here to, again, aggregate content for you as the researcher. So we begin, we're going to, again, in this topic page, we're going to talk about, some of the changes with the pre and post 12/31/21 beginning cutoffs that were put in place based on the TCJA, and what some of those pieces of information look like, the before and the after. As we scroll down through this topic pages, we're going to give you some additional explanations. What are some of the definitions? What are some of the pre and post? Again, what we've done here is orientate you within the topic pages because we're talking about a business expense. In this case, we're looking specifically at the research and experimental expenses component of the business expenses. But as you can see here, again, we've put all that information into a single location, so you're not going back to search results to take a look at what actually exists out there for you. We also have a tool called our client impact, where we talk about the actual application of the issue as it relates to your business or to your clients, as discussed within our client impact tool. I think what's really important again here as we take a look at the key primary sources is there's a lot of activity here. And if you think about how you would go about getting to this information and the cumbersome nature in which you had to do this previously. But what we've done now is pull together all the enacted laws. Remember, we talked about the topic page being the holistic overview, and this covers multiple different code sections that are out there. So we've listed those here. If you want to go directly into those regulations, they're available from this screen as well. The revenue procedures, we talked a little bit about the IRS notice that came out a few weeks ago. We've also put that piece here so you're able to go directly into that without having to go back to search results and look for that. Again, another piece of the CCH Answer Connect solution is we've started to pull in our smart chart technology directly into our topic pages, as well as our code section view, which we're going to take a look at in a moment. We've also brought in practice aids, decision tools, election and compliance, work papers, all of that information that you may need to use to take your fact pattern that you're dealing with for your organization or for your client and actually turn it into a practical piece of guidance that you can use. We also bring in news where we begin to aggregate all of that information as notices come out. We push that information to you on a daily basis, but we also put it directly within the topic pages. So as you're doing your research, you can see what is being discussed. We put our forums, our publications are also here, as well as our CPE learning tools. Again, if you want to go dive deeper into this, get some CPE credit, or just do it for professional development, we made that available for you here as well. I'm going to jump back up into that recommended topic component. Into my key primary source component. And we're going to go directly into that IRS notice that we've talked about. And what we are now doing is jumping into our code-based discussions of the relative information here regarding 174. And again, this was a really large transformation based on what we heard our clients looking for and asking for, is that they wanted to have all the content related to code section 174 in a single location. They didn't want to have to go find it or click on multiple links to be taken to it. So within this 360 view, as we've called it here, we begin with your code section. I know we jumped directly into that notice. I'm going to go jump back to the far left where we have that code for all of 174. You then have all the related regulations for 174 brought to you. Again, we have these specific explanations where we dive deeper into the sections of the code and all that information that you'll need to interpret as you go through this process. We've talked about the pubs and the tools. We've also brought those to you directly from this page. Another interesting component is what's going to happen as the states have to begin reacting to this. Are they going to be adopting the federal regulations? Are they going to be modifying them? What are they going to do in terms of what the feds have done? So you actually have the ability to jump into the state in which the transaction's taken place and determine what your next step action will be as it relates to the state content specifically. Great deal more that we could talk about within the CCH Answer Connect solution. Just wanted to give you a really quick overview. We're coming up on the top of the hour, so I want to pass it back to Margaret for our final polling question.
Thank you, Kevin. That wraps up today's webinar. I want to thank everyone for their participation. As a reminder, CPE credit will be posted within 2 to 4 business days. You will receive an email with a link to the course evaluation and your certificate of completion. Today's webinar has also been recorded. You will receive an email with access to that link within 24 hours. Thank you for attending and have a great day.